All right, today we're going to be talking about hedge on demand and how to protect your account when the market is already falling. This is an important topic for many option traders out there, and I know you have different ways of protecting your account, but oftentimes you find yourself without any proper hedge, and the market quickly turns on you, and you don't know what to do. So you try to go and buy some puts, but they're now expensive and might not help you as they would if you bought them before anything happened. So it's not always easy to know what to do. So your deltas are getting out of line. You're trying to close some trades to bring that down, but then what happens is you're closing your trades way before they should be closed, before they reach your maximum loss, and therefore you're booking some losses. So today I'm going to talk about hedge on demand because that's one of the ways that you can buy yourself some time and allow the probabilities to work out with your other trades, and it can be quickly put on. It's pretty powerful. Yeah, let's go right into it. So first, let's touch on some different kinds of hedges, just to give us a start here. So we have some small grind down hedges. We could have some intermediate hedges, big doomsday hedges. Some hedges are temporary, some are permanent, and you can have all different kinds, and you can combine different ones. But today specifically, we're going to talk about this hedge that's considered probably intermediate hedge, and it's a temporary hedge. It's not meant to be there all the time or to be continuously rolled or anything like that. This temporary hedge is part of my 1-to-1 plus trading system. The whole trading system includes the main income trade, then the grind down protection, and hedge on demand. The hedge on demand is meant to protect the main income trade when the market is turning down, because the main income trade is basically always a positive delta trade. So that when the market turns down, the deltas can quickly get out of line, and we need to be able to bring them back in. Why? Well, it's pretty obvious, but let's just touch briefly on some of the reasons: to protect your account, to reduce drawdowns, to quickly reduce positive deltas, to reduce buying power usage, buy time, and allow trade to stay open longer. I touched on that briefly before, and maybe to avoid margin calls. And there could be other reasons as well, but these are just main ones that I wanted to touch on. Some of these are like obviously self-explanatory, but just I want to touch on this: allow trades to stay open for longer. And this is particularly important if you have any kind of stop loss in your strategy. And let's say you have a 200% stop loss. When the market turns down and your delta start increasing, you might not reach any particular trade might not reach the stop loss target, but your deltas might be so out of line and your buying power might be high, and you're getting obviously worried, and you might be forced to close that trade, and thereby not allowing probabilities to work out, and your long-term projections will be off. So by quickly putting on hedge on demand, you bring your buying power in line, your deltas in line. Then you can allow that trade to stay a little bit longer, because there's a legitimate chance that it could go back, the market could slow down, could turn back up, and you will still take it off when it reaches your stop loss. But in the meantime, you'll be making some money back on the hedge if the market continues to go down. So when you could use different signals to open the hedge. You could be mainly concerned with your own metrics, or you could look into market to do it. I personally generally look into my own metrics. So if delta reaches certain threshold, I would be looking into putting on the hedge. But you could also look into market dropping a certain amount, let's say a certain percentage in a day or two. Or if you know you're not going to be able to watch the market closely for a few days, or even a week or so. Let's say you're going on a vacation and might not have a laptop or something. Then you don't want to be worried about your positions. So you might as a precaution put this hedge on for a few days, just to give you a little bit better sleep. And now the how. So this is basically a put debit spread in ES. The expiration closes to 60 days, with the initial cost of roughly around 1% of your account net lick. Now we can talk about that a little bit later on. You can change that to go a little bit less or a little bit more. This is just a rough guideline to keep you kind of steady and to be able to quickly calculate and everything. So you will see in a minute how that works. The final cost now, this is just initial cost. The final cost is going to be 1/4 of whatever the initial cost is. So if you put it on for $400, you will be taking it off with $100 loss. So it's going to end up costing you $100 plus whatever commission you had to pay to your broker. The width of the spread is 1/2 of the cost. So for example, if you're paying $400 for the spread, the width should be 200 points. 200 points equals 10,000 in the actual value of the spread. And the spread to cost ratio is 25-1. And that's automatically done. Obviously, if you just look for half the width, it will end up being 25-1 ratio. Now for larger accounts, you can open a couple of smaller ones or 2 or 3 smaller ones instead of one larger hedge. Somewhere around 400 and 800 usually works the best. And then you can divide, let's say you have a $200,000 account, so you want to spend around 2,000. Maybe you can do 3 hedges for 600 each or something in that neighborhood. It doesn't have to be exactly one trade, because once it gets too large, the metrics change a little bit, so it's no longer the same risk reward and same responsiveness. So this is for the cost and taking it off for a loss. And when it comes to profit, we're looking to take it off when it reaches roughly 600% of the initial cost in profit. So in this particular case, we had $400 in cost, initial cost. So 6 times that would be 24. So 2,400. We would be looking to take this hedge off if it reaches 2,400 in profit. So we're going to touch briefly on the closing. So closing for loss. We are closing it for loss if it shows 25% loss, which means the markets have either gone up or the IV has contracted significantly, and the trade is now showing loss of 25%. So if we paid for it 400, if it now shows value of 300, we should then sell it back for 300 and book $100 loss. This $100 in this case would represent 1/4 of our overall net lick. Remember, 40,000 was the account value roughly. 1% was the initial cost, which is 400, and then 1/4 of that is 100, which is 1/4 of the net lick. So you can, this way you have a rough idea. Every time you put this trade on, it's going to cost you, unless it goes into profit, it's going to cost you about 1/4 of your net lick. And then if we're closing it for profit, 600% is what we look for, but we can decide at the time to keep it a little bit longer or close it sooner, depending on the circumstances at the time. 600 is the initial target, but again, you can think about it when you get there. But you do want to take it off at some point, because it's very likely that it's not going to realize full profit. So at some point, it's going to start contracting and losing value, and then you might end up not cashing in. So you're looking for an optimal point to cash in, and 600%. It's a good starting point. You can find something maybe that suits you better, but at least you have this to start with. So let's run an example. In this case, we're looking at an account with a net lick of 42K, and available ES is 61 day is the closest one to 60. Initial cost of the hedge is 400. The spread width is 200, and the spread value is 10,000. Initial delta of the long strike is 0.1. Initial delta of the short strike is 0.04. Now, obviously, these deltas will change, and it's not precise that it's always going to be 10. But this is where you can start to look to form your hedge. And in this case, strikes are 3,900 and 3,700. And the initial overall delta of the hedge is 0.06, which is actually 30 SPY-weighted negative deltas. So if your account was over by 30 or 40 deltas, this will bring it quickly back in line. So now we're looking to closing this hedge. The market has recovered at least temporarily, and or IV decreased. Current hedge value is $300. which is 25% loss from the initial price. And in a way, we temporarily rented a much stronger hedge than we could afford to buy. So, because the actual cost would be 400 if we were to keep it, but we're just renting it until we figure out whether we need it or not. And this, we don't have to really think about it. The metrics tell us if we lose 25%, which means for the moment we don't need it anymore. But if it continues to go down, then we know we need it and we're going to keep it on. And closing for profit, let's say the market continues to go down and IV increased, the hedge value becomes 2800. This shows 600% profit from the initial price. Once we take out the initial cost, 2400 is left, and that's 600% profit. And then we would close it, and that's it. So now let's hop onto the platform and try to put one of these on. Okay, so let's say I want to put a hedge on demand today. I wouldn't necessarily need it today because my metrics are in line, but if I did, this is how I would go about it. First, go to ES, and then we're going to look for an expiration that's close to 60 days. Between these two, I'll go to 53. I don't really want to go too much over 60 days, so let's go to 53. And for my size account, which is around 50K, the default would be 500 for the cost of the hedge, initial cost of the hedge, but you can all move up or down depending on if you really want to bring more negative deltas in. If you're a little bit more out of line, you can go for 600, or otherwise you can go for 400 or something. It doesn't really matter. You can start at 500 as a default and then move on around, and it doesn't have to be 500 exactly. We just want to be able to quickly put on the hedge that makes sense. In this case, let's go to around 10 delta, roughly 9, 10. Okay, so let's see, 3900. Let's put a long at 3900, easy to calculate. We're looking for half the cost in width. So since we're paying 500, we're looking for 250 width, and 3900 minus 250 is 3650. So let's go and take a look at 3650. Now this one is a little bit under 500, as you can see here, 450. So we could leave it here, or we can try and move it up. Now here you will have 25 increments, and up here are 10. If we go here, so here we're a little bit over. It doesn't really matter. Either one will work. So let's just leave it here for the purposes of presentation. So as you can see here, we're paying 512 and max profit 11,987. So the total value of the spread is 12,500. Max profit just short of 12,000, but we're not going to wait around for that full profit. We are planning to take this off at around 600% profit off of the initial cost, and the cost was 500. So we are looking at, let's log this price here, 500, and the initial cost was 500. So 6 times that is 3,000. And how would we achieve that? Well, let's take a look at the curve here and today, and let's assume that the IV would go up, and if the market is now at 43.56, if it goes down to say around 4,000, it's likely that the IV would increase, I don't know, maybe 8 points, 9 points, something. It's hard to say. You can't obviously know that, but it's not unreasonable to expect the IV to go to 26. It could be any number really, so take this with a grain of salt, but roughly speaking. And if the market continues to go down, we should be approaching our profit target somewhere around 4,000 or something. It could be a little bit, if the IV goes higher faster, we would reach it sooner. If it goes, if it takes a little bit longer, and it would take a little bit longer. But we're not looking for 20% pullback in the market. This is like from 43.50 to, that's like 400 points. So 10% roughly. That's probably where you should look to cash in. And this money obviously would be offsetting some of the money that you would be losing on your 1-2-1s on the other side, because we have those going on right here, and then some of them would be losing money. Probably all of them would be losing to some degree, and this would offset portion of that. So Why is this hedge so powerful? Well, basically, it's powerful because for only, in this case, for only $125, because that's what we plan to spend, one quarter of 500, we're getting a 500 worth of hedge. So 4 times the strength. So, this is because basically we are renting this strong hedge. We are renting it for a short period of time, and then once we don't need it anymore, we take it off, we return it back. That's the thing. However, the flip side of that is obviously that we have to take it off if the IV goes down or the market goes up, and that can happen soon. Sometimes, it can happen next day if there's a huge contraction in the IV or the market goes up. So there's a chance that you put one of these on, couple days go by, you take it off, and then you might have to put another one. So there's always a trade-off, but this is a good way to quickly react to market movement and protect your positions really quick. And I think that's all I wanted to show you on this hedge on demand. And thank you very much. Have a good one. Bye.